Okay, we're back discussing the decision of private companies to tap into the markets by going public. There are no Twitters or Facebooks here, but still some of the biggest Canadian companies, think McCain Foods, Irving, and Pattison, are privately held. For a look at the Canadian private equity scene, we're joined by Bill Ainley, senior partner with Davies, Ward, Phillips, and Weinberg, and Miriam Varadi, a former investment banker and author of Merchants of Enterprise. Good to have the two of you with me today.
Thanks
for coming in. So, we were talking about Facebook with Colin Bladen, and I just saw a bullet. Wall Street Journal is reporting that Goldman can now offer it to non-U.S. clients as well. You had some thoughts on Facebook, Miriam, before we get to the Canadian scene you wanted to hit on.
Yes. I think the Facebook-Goldman Sachs deal is a game changer.
In what sense?
And it's a because it's a victory of private markets over public markets. In the past, companies as important as Facebook would go public at this point for two reasons. One, it gave them a certain branding and prestige. And two, it was a way of raising money, a lot of money, so you could grow. What has happened here is Facebook has said, we don't need the prestige or cachet, as you put it, of the New York Stock Exchange. We're Facebook.
Yes.
Yes, but we're Facebook. We have it.
What do you think,
and
Bill?
On top of it, I just want to finish the thought. On top of it, they've managed to raise $1.5 billion, and the issue was oversubscribed without going to public markets. What I think it'll say, just to get to the conclusion, what I think will happen is this says companies can stay private a lot longer before they go public.
Do you think that's true, Bill?
No, I do think it's true, Howard. I think that's been a real evolution in the marketplace over the last 20 years with the growth of the private equity market. And so what we're seeing, as Miriam said, is an ability to generate significant capital through private markets. And as you were talking with your earlier speaker, there's a real kind of cost-benefit analysis to going public. There's a lot of pain involved in being public. There are benefits, but there's a lot of pain. So, 20 years ago, if you had a really developing private company, access to capital to grow the company, the public markets were kind of your only choice. And it was kind of that analysis, do we need the capital? We got to go public. Now, a lot of times, actually, the private markets will be a much better source of capital than the public markets, depending on your business and the stage of your business. So, when you're at a development stage or a venture kind of a stage, public markets a lot of times won't give you the same kind of valuation. It won't have the same kind of patience as private markets will. Mm-hmm. So that's been a huge development. And, where I see entrepreneurs who've started a business and it's going well and there's starting to be some real interest, in the investment banking community around them. And it kind of puts on their agenda whether they should go public. Almost inevitably, they need to now develop a sort of an alternative process and run with both of them simultaneously and see, let's get ready to go public. Let's do all the things we need to do. It takes a bunch of months. But let's also entertain the possibility of doing, in effect, an exit at liquidity to private equity investors. And let's just get, an auction going, in effect, between private buyers and public buyers. And see where the markets are actually going to value this company, in reality, not in theory.
A specific example in Canada, if I may, Porter Airlines, as we all know, came on the scene a few years ago with private investors and was ultimately trying to go public this past year, but then the markets weren't quite, rosy enough for them. What do you think of an example like that, Miriam? Because obviously they're trying to do it in two ways.
Well, the unfortunate thing in the case of Porter was the timing just didn't work out right. But private and public markets are a continuum. They depend on each other. Private companies go public, public corporations go private. And this will always be the case. The question is that we now have a growing private market, and that's really the game stopper.
And so how much of that are you seeing? Are you seeing a lot of your clients thinking, hey, I'd rather just trade on these secondary markets?
Well, often the driver for considering seriously going public now, if your company has already gone to the private equity market, So say for a period of time there's been a collection of private equity groups that have controlled you, will be a liquidity event for the private equity investors. So sort of you as the managers or the original founders of the company may be saying, no, we kind of like this, but you've got a group of private equity investors, funds potentially, who have a 3 to 5 year investment horizon. The capital markets have been tough for IPOs for a few years. So a lot of companies are looking at, in effect, almost a forced sale. Their private equity owners are saying, we've held this for longer than the time period we were supposed to hold this. We need a liquidity event. Either we're going to flip it to more private equity investors, which can be a very tough thing, private equity to private equity, or we're going to go public, which is the traditional exit plan for the sort of 5-year private equity investment. So you get that driver. And as Miriam was saying, those two markets don't, ebb and flow in sync. Mm-hmm. They ebb and flow at different times. So, one of the challenges for going public has been that there's been a sort of a whole generation of private equity investments that are past the time when they should be going public and haven't been able to go public because the capital market's been tough on IPOs.
Right.
So you get that kind of sell-side pressure. So, a lot of times it kind of depends whether the public markets are receptive and whether the private equity markets are kind of almost forced sellers.
So what you're saying, just so we understand this clearly, Bill, is a lot of the private equity deals that were done in 04, 05, they've had to wait past their normal exit strategy cash-out time because of the markets.
That's exactly right, Harvey.
Right. So Miriam, is it tougher to go public than it used to be?
Is it tougher to go public? I think what's happening is owners have more of a choice than they've ever had. I think whether you go public or you stay private, well, as we just said with Porter Airline, that was just unfortunate timing. Mm-hmm. But I think the big thing will be, what does the private owner want to do? Mm-hmm. So he has more choice.
I don't think it's tougher to go public, Howard, but I think over the last 10 to 15 years, it's become tougher to be public.
Like with Sarbanes-Oxley and so forth.
Exactly, and that was then. But, there have been a whole series of sort of events in the marketplace that have caused the sort of scrutiny on the public company and its reporting and its certifications and, how it organizes itself to be very, very time-consuming for the managers. And, a lot of criticisms of some of these developments have been around what boards of directors now do. They don't really provide a lot of great ideas for the growth of the company. They're more assessing risk across a whole variety of kind of areas of the company, but it's all kind of risk assessment. And so that's a very different sort of an input and a profile for the board of a public company than a private company. So I think, you find a lot of entrepreneurs who have developed and run private companies who find the constraints of quarterly reporting, of, investors' expectations